Lehman Brothers began in 1850, when three brothers who had emigrated from Germany opened a small dry goods and cotton trading store in Montgomery, Alabama. Over the next century and a half, it grew into one of the largest investment banks on Wall Street. By 2008, Lehman Brothers was the fourth largest investment bank in the United States, deeply involved in underwriting and trading mortgage-backed securities, the same assets at the center of the unfolding subprime mortgage crisis. Internally, Lehman had been leaning on an accounting maneuver known as Repo 105. At the end of each quarter, it temporarily moved roughly $50 billion of assets off its balance sheet, making its leverage look lower than it actually was, then brought the assets back once the reporting period closed. A bankruptcy examiner's report released in 2010 concluded that Lehman's use of Repo 105 to understate its leverage was materially misleading to investors, even though it did not result in criminal charges against the firm's executives. As Lehman's losses mounted through the summer of 2008, federal regulators and the heads of the major banks gathered for an emergency weekend of meetings in New York, trying to find a buyer before markets reopened Monday. Treasury Secretary Henry Paulson made clear to Lehman's leadership that, unlike earlier interventions that year, there would be no government money to rescue the firm. Lehman needed to find a private buyer on its own. Barclays, the British bank, came close to agreeing to buy Lehman. But UK financial regulators refused to approve the deal over the weekend, unwilling to let a British bank absorb Lehman's risk without more guarantees, and the agreement collapsed. Bank of America also explored buying Lehman, then turned its attention elsewhere, agreeing that same weekend to acquire Merrill Lynch instead, another major Wall Street firm shaken by the crisis. With no buyer and no bailout, Lehman Brothers filed for Chapter 11 bankruptcy protection on September 15, 2008, listing about $639 billion in assets against $613 billion in debts, the largest bankruptcy filing in United States history. Lehman's stock had already plunged 93% from its prior close, wiping out more than $46 billion in market value. The Dow Jones Industrial Average fell 4.5% that day, its worst single-day decline since the September 11th attacks. Just one day after letting Lehman fail, the Federal Reserve authorized an $85 billion loan to the insurance giant AIG in exchange for a nearly 80% government ownership stake, judging that AIG's failure would be even more dangerous to the financial system. The contrast became one of the most debated decisions of the crisis. Regulators judged AIG too interconnected to the rest of the financial system to fail, while concluding Lehman's failure, however damaging, was containable. Many economists and former officials have since argued that judgment badly underestimated the shockwaves Lehman's collapse would send through global credit markets. Within weeks, panic across frozen credit markets pushed Congress to pass the Troubled Asset Relief Program, authorizing up to $700 billion to stabilize the banking system. Signed into law on October 3, 2008, the large-scale bailout regulators had just tried to avoid.